Christopher, let me throw up this chart that takes a look at just how divergent you see global tax rates, corporate tax rates there are, according to this BTV chart that we've got up on your screen now. How much of a game changer is this, knowing, of course, we need more countries to sign up and more of the details to be ironed out as well?
It's a big game changer. I think, as you point out, there are a lot of hurdles ahead, but it's not often that you get major global companies actually cheering a coordinated tax increase. And that's because the only thing worse than a coordinated tax increase is the uncoordinated tax increases they've been seeing in the last months and last couple of years as different jurisdictions try and claim an extra share of their profits. Famously, the U.S. and Europe disagreeing over tax collection on large U.S. tech firms. But it's a big breakthrough that there appears to be a path ahead on a range of tax issues.
Christopher, I want to take us to our question of the day, which is how would that 15% global corporate tax affect assets? I mean, is it an automatic thing where you'll see stocks go down? Is it destructive for shareholder value?
Well, taxes in general, obviously take away from the bottom line. But I think this is something that has been well advertised. It's going to hit different companies in different ways. I think a lot of the bigger tech firms already pay an effective rate that is around 15%. So I'm not sure they're going to be directly hit. It's really going to be a company by company story. But again, I think it's not going to be the news is not so much taxes are going up. It's that the coordination of tax policy is going to make it much easier for global companies to plan and to make their tax strategies and start cooling some of the more populist pressures on them to pay more.
After those G7 talks, we also heard from Secretary Yellen talking about higher rates being a plus for the Fed and also American society. What do you make of her comments?
Well, you would normally expect markets to start selling off sharply when the Treasury Secretary talks about higher rates. But I think what she said is what everybody knows, which is that we've all been concerned, frankly, through the pandemic about lower rates and deflationary pressures. Right now, we see strong recovery in the U.S. and other jurisdictions around the world. So it's not surprising that inflation starts to pick up, that rates start to pick up. And that's a sign of recovery. And frankly, for a lot of interest rate sensitive stocks or a lot of financial stocks, for example, that's a big boon. It's going to be helpful to a lot of other assets, as long as the rise is slow, predictable. And that's what we have every reason to believe it will be in the months ahead.
And of course, exacerbating these inflationary pressures are the current bottlenecks when it comes to supply chains. We had a really interesting Bloomberg opinion piece talking about how the biggest threat to Joe Biden's infrastructure program is not really having to pass it through Congress, but it's the fact that those companies that will be relied on for those projects are facing massive shortages of everything from workers to cement mills. How do you expect this supply chain disruption to actually solve itself out in the policymaking space, but also in the markets?
Well, I would first of all disagree. I think the biggest obstacle to Joe Biden's infrastructure plan remains Congress. And we'll see how he's able to negotiate that and how he cuts up the program to try and get it through this particular configuration. In terms of the supply chains, it really isn't surprising. I mean, a year ago, we shut down the global economy. And now, as growth recovers at a pretty good clip, it's not surprising that we're seeing shortages of workers, of supplies, the wrong things in the wrong places. I think we've all had some experience with that if you've done any home renovation, as I have. But I think those are the kinds of things that in time will sort themselves out. I think the other thing to keep in mind as an investor is that this is a time of very noisy data, very confusing data. And you saw that on the jobs number last month. Much better last week on Friday when we got the jobs report. But just as the data was so messy going into the pandemic, it's going to be a little bit all over the place coming out of the pandemic. So I think it's better to keep an eye on the broader trajectory, which is continued strong growth and fairly moderate inflation.